Mortgage industry in 2022. How are we looking? There's been a lot of changes through COVID. So we're going to take a look today and explore this a bit further with Jim Gallagher, who is president of Fairway Mortgage. He's been in the business for what, Jim? Close to 30 years?
28 years.
28 years, yep. Jim's been in the business. And we also have Cathy Kantrowitz, who is both the assistant vice president of residential underwriting with Rhinebeck Bank, as well as the president of the New York Mortgage Association. So welcome, Cathy.
Thank you. Nice
and
to
Jim.
see you.
Thank you.
So we're going to get right into this. I'm going to start this out actually with Cathy. If you can just kind of give us just a little bit, there's been a lot going on. We've got interest rates, have been rising. My understanding through conversations I've actually had with Jim, we were looking at rates in February of 2022 that were 3.125. And then we're looking at, rates in May of 2022. And in just those few months, a $500,000 buyer, if they don't have additional funds to make up the difference, is really looking like more like a $400,000 buyer now, only a few months later. So there's a lot going on in the mortgage industry right now. And, I think there's, some definite concern about what's ahead. I mean, what's your take as being the president of the New York Bank Mortgage Association? What's your take? What have you been hearing?
Thanks. First, Sandy, thanks for asking me to participate in the conversation today with Jim and yourself. And yeah, we've definitely seen some rise in rates. The National Mortgage Bankers Association has put out some data from their economists. Rates have gone up over 1.5% just in the last 2 months or so. So that's definitely having a big impact on the buying power of our borrowers, particularly those that may have been pre-approved 6 months ago or more. And now the rising rates is definitely, having a negative impact on what their purchase prices are and how much they can afford to borrow now. So that's one, tip for folks is,
and I'm gonna actually interject just for one moment here, a little perspective with that too, because my understanding is that there was a time where people had 10, 15, 18% interest rates, but the reality is, from my understanding of this, is that we are actually at the highest point in interest rates right now than we've been since 2009. Is that correct?
I want to say that I even saw something like it's at the highest it's been in longer than that. Anyone who is in recent years in the industry thinks that 5% is very high for an interest rate. So to your point, for perspective, yeah, a 5% rate on a mortgage is still very good. I mean, the 2s and the 3s were outrageous. So 5% is still rather low.
I mean, it's interesting to go from historic lows, right? We were in historic lows only a few months ago to now, highs that we haven't seen in quite some time. I mean, Jim, do you have anything to add to that?
Yeah, it's I've gone back into my pipeline and reached out to clients that I pre-approved 6, 7 months ago, a year ago, to kind of pre-approve them to see where they stand, because a lot of consumers are just not aware that rates went from 2.75 to 5.5% in 4 or 5 months. But yeah, like Cathy said, that's still a historical low rate. When I bought my second home 22 years ago, the rate was 8.375%. And the first probably 10 years of my career, rates were 6, 7, 8%. Almost in 1995, they almost got to 10% on a 30-year fixed rate. So yeah, 5% still a great rate, but yeah, it has impacted a lot of people who were looking when they were in the 2s and 3s.
Now, actually, I'm going to back up for a second because I didn't introduce myself. I'm Sandi Park, and I'm an associate real estate broker. I've held my license for over 20 years. I worked in Westchester County for many years before relocating about 4 years ago up to Dutchess County. Now my focus is on Dutchess. I also work in Ulster and Columbia counties primarily. Still go to Westchester for clients that refuse to accept my relocation. But what I've been noticing with my clients lately is actually not even so much noticing. What I've been recommending to my clients We are still in a very highly competitive seller's market. And, I've been having all of my financed buyers get new pre-approvals, even though the shelf life on a pre-approval is what, Jim, 90 days?
It's really about 60 days because it's your credit report's only good for 4 months. And then a lender typically likes to get a file and have that credit report good for another 60 days. So you can really say a pre-approval letter maybe has a 60-day shelf life. And if you haven't found a home and gone into contract within 60 days, you probably should get another credit report run, just to make sure nothing pops up and your score is still the same and, something negative didn't pop up and hit your credit. So I'd say 60 days is the shelf life.
Okay, so that's the normal. That's in normal times, 60 days of shelf life. But if we back up 60 days from now, from here we are, we're in the middle of May. All right, we back up 60 days to the middle of March. And again, as I was just saying before, a $500,000 buyer in February is really looking more like a $400,000 buyer in May if they don't have any additional finances available to them and liquidity to add in. So with that being the case, what I've been recommending to all of my buyer clients, even if they have a pre-approval that is within 60 days, is get it updated. And there's multi reasons for that. One is let's make sure you're looking still in the price range you can afford. But the second is also to position them stronger to sellers, because not all buyers are going to do that. And, I make sure that when I have the buyer client and I'm submitting my buyer client's offer, that I'm making it very clear to that listing agent that these interest rates have risen and my client went, the extra mile to go and have a, as of today type of pre-approval to show that, they are still in a position to buy at this price point. I've used it to kind of leverage a bit, in this kind of a market, you use everything you can to leverage. I use it a bit to leverage and position my buyer clients, as that much more solid by having something that's really up to date. So, I think on multiple levels, it makes sense to take a look at that and make sure that pre-approval is definitely no more than 60 days. But, again, with these changing interest rates, really to probably stay on top of it even more so.
I would say even on a weekly basis now, if you have a pre-approval letter dated even a week or two ago, you might want to call that loan officer who generated that pre-approval letter to make sure that rates are still what they state on the letter. I usually put my interest rate on the pre-approval letter along with the amount that they could qualify up to and estimated taxes and what they're going to put down as a down payment. So you might want to even check on one that's a week or 2 weeks old.
Okay. And Jim, your camera is kind of moving a bit. So if I'm not sure where it's positioned on your desk, but I just want to mention it's jostling a little bit. It's just a little bit. I know you've got a lot going on.
Yeah, no, on my Zoom thing, I have the background blurred. So I think it's the setting in Zoom.
Okay. All right.
It has blurred the background. So
all right.
yeah,
so you know what, everybody,
it's
okay. It's you're keeping on moving. It's all good. Cathy, do you have anything to add to this piece of conversation as far as, when you're actually, this is an interesting piece. We're going to get into the underwriting part of this in a moment. But before we get into that, I really want to kind of dive in a little bit more into conventional mortgage versus FHA mortgage and just kind of discuss that and then get into underwriting. But just while we're on this topic of the pre-approval, have you seen any instances coming through your desk of people who have pre-approvals that are dated in March and all of a sudden, now they're trying to process a mortgage and they're having problems? Have you been seeing that?
Yeah, we have started in a couple instances where, our loan officers have brought them back to say, hey, we need to take a look at this again. But just one other piece to that I think might be worth mentioning, and Jim brought this up, the most pre-approval letters these days do have the interest rate and some estimated tax amount along with the mortgage amount that they qualify for. And one piece that I think sometimes borrowers don't pay quite so much attention to because everything is so rate focused is the tax amount. And as we all know, our taxes in our area, can be significantly high in certain areas. And even, you know, as we're talking about a difference in an interest rate causing, you know, the monthly P&I payment to go up as interest rates go up, if those tax amounts change, that also impacts the amount they qualify for. So just want to kind of bring that up as a little tip, something to be focused on.
Yeah,
Awesome.
yeah, that's a good point. I was just at a closing yesterday for a client I did a mortgage for in Rhinebeck, and the attorney, her attorney, was telling her that her property had gotten reassessed already, and they reassessed her property from 205 to like 256. Now she's already closed, but that would certainly impact someone if she was going to sell her property. Now it's going to tax at a higher amount than she just closed on.
Well, it's interesting that you raised this. You know, I publish a newsletter called The Brick, and I'm working on my next issue, which I will be addressing, you know, different pieces of what we're discussing today in The Brick, as well as quite a few other topics that are going on here that are wild cards and the sidelines that I think have a very real potential of impacting our market. And actually, you can subscribe to that through my website, which is www.hudsonvalleynest.com. But one other piece that I'm going to be addressing are taxes. I'm going to be getting into detail on that because I've actually been talking with all different tax assessors as well as county and state, you know, trying to get my hands around this because it's a very real issue. The tax rolls actually went out May 1st. And my understanding is that anyone that is going to have an increased assessment has been notified by this point. And just using Dutchess County as an example, you know, they're going into it quite a few of the towns are using trending, and they have certain percentages that are increasing those assessments. I'm going to get into taxes in more detail in the next video. So I want to sidebar that for the most part, but what I do want to say is it absolutely, you know, I see what you're saying. And I had a house even before these assessments. I had a house in Poughkeepsie that was assessed at, you know, it had $10,000 taxes up until August of 2021. And then the property taxes went up and now their taxes are $16,000. Well, you know what? That's a pretty substantial jump. And that really makes a difference in you know what your ultimate buying power is if you have a certain monthly nut that you're trying to stay with.
Absolutely. Yeah, I totally agree. Yeah.
All right. So I'm gonna go ahead, Jim. Sorry.
Oh yeah, I looked up. Yeah, and with every pre-approval, if someone has a specific property that they mentioned to me, I go on to Dutchess County's website and I pull up the county, village, and school tax, so I can see what they are and what they are without any exemptions. So always using an accurate number on a specific property when I'm doing a pre-approval.
Jim, it's like you read my mind. So I think the next thing that we need to get into at this point, let's get into the pre-approval. So, you know, someone's calling you, and I'd like to really, you know, we've got, you know, the W-2, you know, full-time W-2, you know, people, and then you've got 1099, right? You've got the self-employed. Yeah. So I'd like to take a look at this because they both exist. And, you know, someone calls you. So, you know, you start with whichever one you want. You know, what are the basic pieces of information that you need from that, you know, potential buyer to really get the ball rolling? Yeah.
So, yeah, I really get into it pretty thoroughly with a new client, and, you know, I could be on the phone with them for an hour or more. And, I send them a checklist of documents to get to me, but I'll ask tons of questions before I get their documents. But yeah, I ask for 2 years W-2s if they're W-2, regardless if they're W-2 or 1099. I ask for 2 years tax returns. I also ask for their year-end pay stub for the previous 2 years, because if they're getting like bonus or commission or overtime, a year-end pay stub will typically show what that totaled. And that's something that you wouldn't see, you would know on a W-2 or a tax return. You wouldn't know how much someone made the previous year in overtime or bonus or commission from a W-2 or tax return, but a year-end pay stub, you would see that. So I'm getting all that documentation. And then you can have, you know, with W-2, you can have people that are on salary or they can be hourly. And you got to, you know, Cathy being an underwriter, one of the cautions is the people that have the fluctuating hourly income. which is always a challenge.
Yes,
Right, Cathy?
to your point, Jim, one of the dreaded, I think, things in the process for a loan officer is when that underwriter says, oh, we need to get a written VOE because we can't figure out, how many average hours they work every week and things like that. And that just, tends to add time to the process. So not
Yeah.
that, of course, everyone, wants things to go as quickly as possible. So the more information up front as to what Jim's saying helps in the underwriting end.
Well,
Yeah.
and I'm gonna also add that, I send, let's just say, a few clients Jim's way. Okay. I like working with Jim. And I like working with other mortgage, it depends on the buyer and it depends upon what they're looking for, and all that type of stuff. But, something I like very much is when you're processing the pre-approval, you're really getting in there. You're getting the information, so that when I get a pre-approval from you, I'm feeling like, okay, this has really been looked into, and putting my seller client hat on when I've got my seller clients, and I get offers from, multiple offers, which for my listings, that's all I pretty much get. So all these offers come in, I'm looking at them, and, quite frankly, some of these pre-approvals, it's like they're very scarce in information. They're unknown sources from wherever. And, I call the banks and I ask them, I'll hound them. Did you get this information? Because really it's not required, right? That you get, you can really just take their information and basically based on what you said, we'd give you X. Right, Jim?
Yeah, the majority of pre-approvals given out are just based on what the borrower tells their loan officer verbally. So we're just, most loan officers are taking that information on its face value. But I like to go above and beyond that and get the documentation to back up, what they're saying. And even more so when the deal's more complicated, that the borrower is self-employed or they own multiple properties, or they got, maybe different types of income. They got trust income or income coming in from, wherever, just not your non-salary wage source. So that's, you want their documentation even more so in the odd situations.
Now, Cathy, this is hitting on you, right? Because okay, so the lending officer is called and culls whatever information that particular bank, broker, whoever gets. Okay, so they get this information. And now I'm assuming that from that point, and actually, Jim, I do want to back up and make sure that we've covered did we cover everything that like a 1099 that you would ask of a 1099?
Yeah, well, a 1099 income, that income, transfers over to your Schedule C on your tax return. So probably like someone like yourself, being an independent, contractor for a real estate agency, you're going to get a 1099. That income is going to flow onto your Schedule C on your tax return. And and that's a thing a borrower will tell you. I made $100,000. I'm Schedule C or 1099. I made $100,000 last year. Okay, well, that's great, but what was your net? And I'll have them. Do you have your tax? I'll say to them, do you have your tax return handy? Right. Let's look at line 31. That's your net profit after all your expenses. And they, that says I made $6,000.
Right.
Yeah, not 100. So, then you have to get into educate the consumer that that's what you have to use in lending is what you're showing to the government, right, Cathy? You can't have your cake and eat it too.
Oh, that's a quandary.
Yeah.
That's a quandary because it's like you. So basically, if you're self-employed, and this is what, 2 years of taxes, Jim?
Yeah, 2 years of taxes. Although some self-employed borrowers, if they're really strong, can get away with just proving 1 year of self-employment, and that's dictated by automated underwriting. So automated underwriting is when you run the loan through Fannie Mae's system or Freddie Mac's system. They'll come back and say, okay, this borrower's self-employed and you can get away with 1 year's tax return if you can prove that they've been in the business for 5 years. Right. Sometimes you can get away with only needing 1 year's tax return. If you need 2, then the income has to be averaged as long as it's stable or increasing. But if it's decreasing, then you could have problems.
Yeah.
Right, Cathy?
Yeah.
Underwriters don't like to see decreasing self-employment
No.
income.
No, we don't. Underwriting does not like decreases in anything.
In anything, yes.
Income, assets,
Yes.
anything. So, and Jim explained it exactly. So he's an underwriter in his other life. So,
Yes. I've been processing my own loans since I took over the company 28 years ago.
yeah. So he's absolutely correct. Most people that are in business for 5 years or more, we can only use 1-year tax returns. And one thing, just kind of a side note, I'll bring up, we had a lot of additional requirements in place due to COVID.
Yeah.
So we were requiring a lot more information on
It was like
self-employed
profit and loss
folks.
and stuff like that, right? During the early stages of COVID.
Yeah, and bank statements and
Yes.
lots of additional things. So fortunately now we're kind of back to the way things were prior to COVID, which is a good thing. So yeah, for any 1099, and sometimes that's not even just a self-employed person. If someone's withdrawing funds from an IRA or an annuity of some kind, they're getting a 1099 also. And that information, if we need to use that to qualify them income-wise, we're going to ask for the tax returns for that as well. So.
Right.
Okay.
Yeah.
So now.
And then Sandy, and then lenders will typically order a tax transcript directly from the IRS to validate the authenticity of the tax return that they're giving to the lender. So
Okay, so see,
Yeah.
so basically, kind of what I'm hearing from both of you, between the lines, okay, is when you apply and you provide all of these, different pieces of financial documentation, it's very important to consider if you own other properties, if there's a judgment that maybe or you don't know about, but or whatever, but and different pieces of income, it's very important to just put everything on the table, because if you have a pre-approval at the front end, and it starts to get into mortgage processing, the reality is, it sounds like you guys are uncovering it, right?
yes, yeah. An underwriter like Cathy, she's like she's like a detective for the FBI. She's like
Yeah.
working through a crime scene. That's basically what a mortgage loan file is to an underwriter. It's a crime scene. They're picking apart, and they're going to make sure that the borrower is not on their Aunt Edna's property out in Wichita, Kansas, because they're going to find that out.
Yeah, and today, we've been doing this a little while, Jim and I both. So, years ago, there wasn't maybe quite so much information available to us so easily, where we couldn't uncover some of this stuff. But with all of the information online that's available, and if we have your tax returns and we're reviewing them, there's not much that we're not going to know about someone. And so it's just better to get it all out up front, as you said, Sandy, because, the longer we go into the process and the more we discover, it's just going to slow everything down. And so, unfortunately, in some cases could almost, have the deal completely fall apart.
Oh, yeah.
And we definitely don't want that to happen.
Yeah. More stones get unturned during the during the process.
Yeah, so
right.
lots of questions up front, which the borrower might not always understand why, but the more complete a package is when it's submitted to processing and underwriting, the better off everybody's going to be.
Yeah, and Sandy, usually an underwriter, and Cathy could comment. I mean, you're not seeing a file, Cathy, until really a buyer is in contract on a specific property, right? You're not typically underwriting like a to be determined property address.
Not typically, unless it is a fairly complicated deal.
Then
If
you'll take a
there's
look at it.
yeah, if there's multiple businesses, multiple properties, especially I can speak for Rhinebeck, the LOs want to err on the side of caution more than not. And, since we have processing and underwriting in, our corporate office, they have access to be able to do that. So, yeah, I mean, they want to be sure they're covering their clients. So, the better off they are to have somebody eyeball it if they have questions.
And in New York State, the contract, we don't fully execute, generally speaking, we don't fully execute contracts until the inspections have been done. So the buyer's already, financially kind of, gotten committed into the transaction by notion of the inspection and supplemental tests and things like that. And now you're in fully executed contract. And now I'm going to close the loop on the underwriting process and then we're going to kind of get into the difference between, I think we're going to focus in more so on the conventional versus FHA mortgage. But Cathy, so it hits your desk. All right. So the pre-approval is done. The contract is fully executed. Jim, that's when it kind of moves over into underwriting generally. Cathy, that's when it goes.
Yeah, once the loan officer has collected all the documentation, then they're going to hand it off to processing and underwriting. The processor will collect any remaining trailing things that maybe the loan officer asked for, but the borrower didn't have, readily available, and they're going to follow up with. And then the underwriter will get the file, mostly complete. There could be a few things missing, but mostly complete, which means income, assets, the property, contracts, any additional properties they own. We need tax bills, homeowners insurance, mortgage statements, anything and everything having to do with that. And any additional, even analyzing the credit report, if things showed up that, maybe there's an extra inquiry that's there and we ought to have to ask, did they get a new car or something, that they didn't put on the application necessarily. So,
and this is actually, there's two things that you touched on with what you were just saying. I'm going to go down one road first, which is, so let's say all the documentation matches up. Everything's looking good. Income is what it was supposed to be. In the meantime, while all this is happening, also there's two very other important components that have the potential to be wild cards in this process that are going on: the appraisal and the title search. Right? Mm-hmm. These are both very big components to actually getting ultimately the commitment. Right?
Yeah. Well, we touched, Sandy, about income, but assets too. Assets could wreak havoc in a loan application. Someone that had large deposits that they can't explain, or maybe they have some outgoing bills that maybe appear like another debt and they're not showing up on a credit report. Reviewing a borrower's bank statements for the last few months is critical too. And that's the question I asked during that pre-approval stage: is have you had any large deposits in your account over the last 2 months? Basically anything that's not payroll related. And try to jog the customer's memory, like, oh yeah, last month I had a $10,000 insurance check from an accident. Mm-hmm. Okay, so we're going to need that paperwork.
Right. And show that. As an underwriter, large deposits to an underwriter mean they took out a loan and they've deposited the money to the account. So we are a little suspicious, I guess you could say, for that kind of thing. And that's where our brain goes.
Yes, that's what I say to my clients. I say we have to rule out the fact that this large deposit you made was a loan, that you went down to the local bank and took out a $10,000 loan thinking you could use that for your down payment and closing costs. Not allowed.
Okay. Let's actually cap on a few of these things, actually. So just as far as rule of thumb, all right, when it comes to this process with mortgaging, one thing is obviously, so avoid large deposits. Okay, right? Avoid large deposits.
Pretty much. If they can't be documented, I give my clients like a list of valid large deposits as long as they can be documented. And then I give them the list of, invalid large deposits, which is, generally cash deposits, money under the mattress, cookie jar, closet.
Yes. Okay. And I would think another thing to try to avoid if possible, is changing jobs.
Yes. Yeah, don't do that.
Yeah, one thing we, especially if, your lender is selling to any of the agencies, we are required to do a verification of employment 10 days prior to closing. So that's not an ideal time for us to find out that someone has changed jobs. So full disclosure is appreciated if that happens. And it doesn't necessarily have to be a bad thing. We just need to know that if it happens.
Right. It could delay your closing. I mean, if someone changed jobs going from whatever IBM, they go to Global Foundries in the same position, they're probably still going to get a loan if they went salary to salary. It's just going to delay their closing because they got to now verify that job. Maybe they need to even show the first pay stub on the job, or at least a contract that they're newly employed. And so, yeah.
All right. So avoid large deposits. Try not to change jobs. And then, so now here we are. Let's say the appraisal comes back good. There's nothing to worry about with that. We've got clear title. We're within days of closing, right? I want a new car to drive in my driveway. I need new furniture.
Yeah.
What's the problem with that?
Yeah. Wait till you close.
Yeah.
Yep. You
The
can go
problem-
hog wild after you close.
Yeah, the issue is that as a lender, not only, do we have to verify employment still, we're monitoring for undisclosed debt. And if someone decided to go car shopping or, buy a house full of furniture and that pops up, and now they have an extra debt per month that we need to include, that could impact them negatively. So we really try to advise to please refrain from shopping of any kind during the mortgage process.
All right.
Sandy, I give my one of the documents I give a client after we get off the phone for the very first time is it's a do's and don'ts list. So it's a list of things to do and not do during the process. I might have shared that with
you. What? I've got to see that again. I want another copy of that.
I'll send that to you. Yeah.
All right. So I think from the process standpoint, I think we've covered a lot of really good information here. Let's just, because I mean, there's the USDA and VA loans as well. And I do not mean to discount them at all, but just from a time perspective, I can certainly put your information up, Jim, for people who have information on those loan types as well, because you are a mortgage broker, right? So there's different, just to kind of touch on this, there's different, when you're looking at a loan, you could go to a local bank, let's say a Rhinebeck Bank. Cathy here works with Rhinebeck Bank. You could go to a local bank. You could go to a credit union, and they have different policies and different, programs that they offer. And then you can also go to a mortgage broker, right? Which is what Jim is. And by being a mortgage broker, Jim has different types of programs that he also represents. Jim represents USDA, he represents VA. So I don't mean to skip over them, but again, we're just trying to kind of, in the process of time, go with the two that tend to be generated more often, which my understanding is FHA and the 30-year conventional. Is that about accurate, Jim?
Yeah. The conventional loan is the majority of my loans and nationwide, probably statistically, probably 70%. For residential loans, the other 30% would be one of your three government loans, FHA, VA, and USD, with FHA probably comprising 25% of those government loans, and maybe 5% would be spread out with VA and FHA. But in New York State, you also have the Sunny Mae program. That's actually one loan I don't do. Used to do them years ago through M&T Bank. But I would, if someone was a good fit for Sunny Mae, I would refer them to Rhinebeck Savings Bank or Hudson Valley Credit Union to do a Sunny Mae loan. And commercial, I don't do commercial loans either. So I refer those to a local lender. Like I actually throw out Rhinebeck all the time for commercial loans. I say they're beyond my scope of expertise. I could do commercial loans, but they're just too time consuming. I don't want to get involved with that consumer.
Yeah.
So let's focus in on the FHA versus the conventional. So let's just start out what's the credit score for conventional? What's the credit score for FHA? What's the, down payment for the minimum down payment for conventional? What's the minimum down payment for, FHA? Can you kind of like boom, 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 boom?
So conventional minimum down payment, if you're under a certain income limit, is 3%. Fannie Mae and Freddie Mac both have a 3% down payment program. Fannie Mae's program is called Home Ready. Freddie Mac's is called Home Possible. So they go by the adjusted area median income limit, which is 79,600 in Dutchess County. So if you make under that amount of money, you could go with 3% down. If you're over that amount of money, then 5% down is the minimum for conventional. FHA's minimum down payment is 3.5%. But you have loan amount caps on FHA loans in Dutchess County, which is let's see, what's the loan amount limit now? It's $420,680 for FHA in Dutchess County.
Okay, and what's the loan limit amount for the conventional 30-year?
It's $647,200, I believe.
All right, now when you're talking 3%, 3.5% down, I'm assuming that's assuming a certain credit score. Yes or no?
Correct. Yeah. So conventional loans typically, I mean, most lenders want you to have a 620 or better score. Although I did have a lender that came out and they dropped this minimum score requirement to no score. So as long as the loan gets approved by automated underwriting, Fannie or Freddie, they'll do it. But you'll pay heavily on for a conventional loan with a 620 score or lower.
Right.
Okay.
FHA now becomes maybe a better option financially for the consumer.
Yeah, agreed. The one thing to keep in mind, all the loans, whether it's a Fannie or a Freddie and even FHA, it's all about the risk. So the higher risk loans, less down payment, lower credit score, those type of things are going to add fees and make it more costly. So that's one of the things that as a loan officer, Jim is looking at to see what's best.
Right. Yeah. Fannie Mae and Freddie Mac have these things called loan level price adjustments. So they're like add-ons to certain risk factors. So you have loan level price adjustments for your credit score, for how much money you're putting down, the occupancy type of the property. Is it owner occupied or second home or investment property? If it's a multifamily home or if it's a condo. And some of these loan level price adjustments, they're cumulative. So they can add up and make a conventional loan quite expensive.
All right. So it's really
like a layering of risk.
When you're looking at these, it's obviously quite beneficial to align with a banker or a broker who really understands these different packages and will really effectively guide different buyers down paths that make the most sense for their financial circumstances, because really a difference in a fraction of a percentage point over the course of 15, 30 years of mortgage could really mean multiple thousands of dollars. So I mean it makes sense to really take a look at these different packages, and if you don't understand something in a package, having somebody who will take the time to really explain things to you. I know, Jim, I just had a deal with an FHA buyer, and there were certain pieces of FHA where I discovered some new stuff about FHA, and it's important for me to know that, not just for my buyers, but also obviously when I'm counseling my sellers, when we're looking at these different mortgage types, because there are inherent factors, whether how appraisals are handled or the down payment, and ultimately the commitment that's in the contract, and if commitments that are with FHA, for instance, trump the commitment of a contract. These are things that are important for me as a broker to really know for my seller clients as well. So it's right. And I lean on you quite a bit, Jim. I call you a lot. We have lengthy conversations. You're very helpful with this stuff. So I definitely would recommend that, again, when you're looking to get a mortgage, take that time to really, connect with somebody, and you really should evaluate between I tell my clients 2 or 3, and I usually try to mix it up. A mortgage broker, a credit union, a local bank, or some kind of other combination, but to really just kind of, compare packages, and compare offerings, and, and ideally have somebody who will really take the time again to explain things to you, so that, this is a long-term commitment that you're making.
Yeah.
Yeah.
Yeah, and that's what it comes down to. I mean, at the end of the day, all the lenders, they, whether you're doing conventional or FHA, the guidelines are exactly the same. Your
Right.
closing expenses are going to be near identical. Might be a slight difference in interest rate from one lender, mortgage broker, or credit union to another. But yeah, it's basically, who the buyer feels more comfortable with, who they're, getting the most information from, and guiding them to the right program choice. And then hopefully the seller will take, if they have to go FHA, I know that's the.
We
dilemma
just
in real estate
accepted FHA, but you do
Yeah.
want to, FHA is a viable loan.
Yep.
But it is important to understand some of the nuances of it, and some of the nuances, the reality is actually a house has to appraise less with an FHA than it does with a conventional, right?
You can finance more typically with FHA. You can finance up to 96.5% of the purchase price.
Okay, that's what okay.
Yeah.
Yeah.
But the buyer is just more protected with FHA with a low appraisal because of that FHA amendatory clause.
The amendatory clause. Yes, I learned all about this one.
Yes, which has to be signed along with the contract up front. Although a lot of times the attorneys forget to put the amendatory clause in the contract. So we end up as loan officers getting it signed after the fact, chasing everybody down to sign it because it wasn't in the contract.
But at the end of the day, whether or not it was in the contract, it trumps that contract.
It trumps that contract. Yeah, the FHA amendatory clause, right? The buyer could back out without penalty from the deal if the house does not appraise for the purchase price, the contract price.
Now,
and the same thing with the VA too. The VA has their own clause called the VA escape clause. So it works the same way as the FHA clause.
Now, this is something that I really had to make sure that my seller clients, because again, we had an FHA buyer that was one of the multiple offers we had on a recent listing. And I really had to make sure that my sellers were very clear with this point. Because of the nature of this market, quite often houses are going for over asking. This particular listing went for multiple thousands over asking. And, I want to make sure that my clients really understood that, even if the buyer is saying, I'll give you 50,000 more than you're asking, and I'll commit in contract that I will make up that appraisal gap with cash, that at the end of the day, that amendatory clause actually trumps the contract. And if the appraisal comes back 30 days, or maybe not 30 days, 21 days later, right? So now basically the house is off the market for those 21 days as far as the seller's concerned, because once you have a fully executed contract showing stop, right? So now the seller's been off the market and the appraisal comes in, and if it comes in low, even if the FHA buyer said, I'll make up the appraisal gap with cash, that amendatory clause would still allow that buyer to walk away if the house did not appraise, not just at the minimum of what the mortgage is, because you were saying the FHA mortgage, I think the maximum is around 420 something. All right. For the maximum
426.80.
Okay. So
odd number.
It doesn't need to just appraise at that maximum loan amount of 426. If, let's just say as an example, an FHA buyer bid or hadn't accepted in contract for, let's just say 470. Okay.
Yep.
The amendatory clause actually goes all the way to the purchase price of 470.
Yes.
Not that 426 loan amount,
No.
where the buyer is protected and could in fact walk away regardless of what the contract says, if that house does not appraise at that, as an example. It is just an example, whatever price over the asking, this is example, it's 470 on, a 430 or something house. that's the deal.
Right, that's the deal, right? Right, 470 is that number it has to appraise at, or the buyer could legally get out of the contract.
All right, so this is very important. It's very important for buyers to understand all of these nuances, but it's also important. I mean, I'm not a mortgage, I am not a mortgage expert, but, and I never present myself that way, but it is very important. I'm working on it. But it is very important for the benefit of your clients when you're a real estate, when you're a realtor, to really have a pretty solid understanding of these packages. And if you don't have an understanding of them, to have someone like a Jim to be able to call and get real solid, honest input that you can then translate to your seller clients. It's very important. I mean, it was important for my clients to really understand this amendatory clause, because we were looking at an FHA buyer, and it was very important that they understand, these nuances.
Right.
So, all right, well, I'm going to close this up. I'm going to say, Cathy, is there anything that you'd like to add?
The only thing, comment I would make pertaining, particularly to FHA, and Jim's been doing this a while, so I'm hoping that he agrees. FHA was a pretty restrictive product for a number of years, but in recent times, they have loosened up some of the guidelines, and they are a little bit easier to work with. So I think FHA, scares people, and they kind of look at it and say, oh no, but I would say in the last few years, it really is a good product for the right borrower. Jim, do you agree with that?
I agree. I mean, someone, most of my clients that go FHA, they get their loan approval, and their list of conditions isn't any different than if they went with a conventional loan.
Right.
And I mean, the only more maybe restrictive part is with that appraisal, and that, that FHA appraiser is going to be maybe just slightly more picky about the condition of the home.
Right.
But I don't like to mislead real estate agents and say, okay, if they go conventional, they can go into the house and appraise the home with both eyes shut and not mention anything, because I've gotten conventional loan appraisals back, with the conventional loan appraiser saying, oh, you got to install a handrail here, and you got some, you got a wobbly step here you got to fix. So
no matter what product, if there's any safety or soundness issues with the home, it doesn't matter if it's conventional or FHA, that's going to have to likely be addressed.
Well, the reality is FHA is it's broadening the scope of opportunity for buyers to secure homes. I mean, it's another channel, and it has different requirements that, again, and the credit score being probably one of the main ones. Jim, correct me if I'm wrong, or Cathy. But it seems to me that one of the main differentiating factor between FHA and conventional is that you don't have to have quite the same credit score in order to get the FHA as you would with a conventional, which opens this up and allows more buyers to have opportunities to have homes.
Exactly. Yeah, someone with like a typically 660 or 680 score is considered top tier credit with FHA. If you that same score, a 680 score, let's say on a conventional loan, you're in a tier, I think it's a tier 5 rating, which goes in 20-point increments. So someone would get a lower interest rate. Their mortgage insurance would probably be lower on FHA. I mean, the one downside to FHA is you're going to have that mortgage insurance for the life of the loan.
Well, now wait a minute.
And there's an upfront premium too.
Well, now with FHA, I'm going to throw this back at you. You're not going to have it for the life of the loan unless your loan to value is
less than 90. If it's less than 90, then it's cancelable after 11 years.
Okay, which actually now, so in conventional, you've got that PMI. You're paying that until you hit less than 80%, right?
So it automatically your PMI automatically cancels at 78% of the original appraised value of the home, with a conventional loan. You can get it removed sooner at the expense of paying for an appraisal
Right.
at
Yeah.
80%. So if you're a homeowner 5 years down the road, you've had your mortgage and you think you're at 80% financing, you haven't reached that automatic termination point yet, but you think you're at 80%, your real estate agent tells them, yeah, you're at 80%. They could call their lender, arrange to pay for an appraisal, and cross their fingers that it comes in at 80%. And poof, there goes their PMI premium.
There's
All right, so
there's no requirement that for PMI, the only requirement I think might be that you have to have had the loan maybe for 2 years to request it to be removed, but there's no, like FHA where it stays on no matter what for 11 years.
Yeah, and also, Sandy, your PMI, your mortgage payment has to be on time too. So if you were 30 days late on one of your payments, the lender could deny your request for PMI termination because they'll view you as a risk and want to keep that PMI in place.
Yeah.
All right. So this is really the reality. There's a lot of different nuances here with loans. So I think
we could sit here all day.
I think the moral to the story is couple of quick ones is try not to change jobs. Try not to have large deposits. Don't go buying a bunch of things until you have walked away from that closing table. Try not to take on new debt. All that is definitely a message there. And with all of these different components of, we just touched on the surface of this. It's really important to do your research. And explore. So I thank you, Jim. I thank you, Cathy, very much for your time. And I will include your contact information, and I will, again, the next BRIC newsletter that I publish, which is Hudson Valley Real Estate, is coming out this week, and it will have links to this, and this will also be posting on YouTube. So feel free to comment and subscribe if you're interested in the newsletter. Take care, everybody. Thanks, Jim. Thanks, Cathy.
Bye-bye. Bye, Cathy.
Bye, Jim.
Bye, all.
Okay, bye-bye.
All right, you guys did awesome.